Welcome to today's market report. European and Asia shares edged down, bond yields eased, and the dollar crept up towards recent peaks on Tuesday, with markets in a cautious mood ahead of congressional testimony by Fed Chair Jerome Powell and Treasury Secretary Janet Yellen later in the day. The STOXX 600 was down 0.4%, while the benchmark 10-year German government bond yield dropped 1.9 basis points to minus 0.329% as Monday's plunge in the Turkish lira and lingering concerns of coronavirus infection rates drove investors to safer assets. The dollar firmed and S&P futures were 0.28% lower, with markets turning their attention to an update from Powell in remarks prepared for delivery to a congressional hearing on Tuesday morning. The Fed chief said the U.S. economic recovery had progressed more quickly than generally expected. The FOMC last week laid out pretty clearly what the Fed's view is with regards to rates. The next thing that markets will focus on is maybe getting some details from Yellen with regards to further infrastructure investments. A mixed bag of new Western sanctions on China, coronavirus concerns, and Turkish tumult after President Erdogan's shock sacking of the central bank chief at the weekend left investors waiting for a firmer signal. The fresh sanctions on China prompted an immediate riposte from Beijing against the EU that appeared broader, including European lawmakers, diplomats, institutes, and families. Adding to the market jitters were further worries over the efficacy of the AstraZeneca vaccine developed with Oxford University after a US health agency said the drug maker may have included outdated information in its data. The benchmark 10-year US Treasury notes last yielded 1.6505%, down from 1.732% late on Friday. Oil also dropped amid ample supply and concerns that new pandemic curbs and slow vaccine rollouts in Europe will slow a recovery in fuel demand. The US crude futures dropped 1.07%, Brent dropped by 1.24% to $63.90 per barrel. Gold futures was up 0.02% at $1,737.60 per ounce. On the FX front, the GBP-USD pair witnessed some aggressive selling during the first half of the European session and dived to 6-week lows around the 137.70 region. The pair came under some heavy selling pressure on Tuesday and finally broke down of the overnight consolidative trading range amid resurgent US dollar demand. Against the drop back of the upbeat US economic outlook, a sharp fall in the equity markets provided a strong lift to the safe haven dollar. The British pound was weighed down by concerns that a significant shortage in vaccine supplies could derail the UK government's plan to exit the current lockdown. It is worth mentioning that the EU reportedly is set to block exports of Oxford AstraZeneca vaccines to the UK. Tuesday's mixed UK employment details also did little to impress the GBP bourse or provide any meaningful impetus to the GBP-USD pair. In fact, the UK unemployment rate dropped to 5% in January, while the number of people claiming unemployment-related benefits jumped to 86.6k in February. Given the recent failures near the key 140 psychological mark, the downfall might have already set the stage for additional weakness of sterling. Market participants now looking forward to the Fed Chair Jerome Powell and Treasury Secretary Janet Yellen's joint testimony before the Financial Services Committee later this Tuesday. In their prepared remarks released on Monday, both Powell and Yellen painted an optimistic picture for the US economy. With limited market-moving economic releases, any further hawkish shift should be enough to provide an additional boost to the greenback. This in turn should pave the way for a further near-term depreciating move for the cable pair, possibly towards the 137 mark. The euro is continuing to consolidate at lower levels in the near term after hitting an intraday low of 1.1836 on 9th of March. Euro-dollar has been trading in a narrow range just below the 120 level. Market sentiment towards the euro is becoming increasingly bearish, and the world's most popular currency pair is set to tank on a break below the 200-day moving average at 118.60. The stronger pushback from the ECB against rising long-term yields compared to the Fed and the BOE, which have adopted a more hands-off approach, has contributed in part to the sharp widening in yield spreads against the euro. The dollar index was up 0.2% at 91.877, just below recent highs. This is today's market news. Thanks for listening. We'll see you next time.